Right. See, this is the syllabus for part 1. External financial reporting decisions. This is where we will study about some of the accounting standards, accounting, say, for example, how to account for assets, how to account for leases, stuff like that we will see. That is 15% of your syllabus. Planning, budgeting and forecasting 20%, performance management 20%, cost management 15%. So these 70% of syllabus are topics with numbers and theory. Calculation, interpretation, everything is there. Last 30%, internal controls, technology and analytics will be mostly theory. Fully theory it will be. So 30% theory, right?
Yeah.
Let's start with one of these topics. We will start with cost management, because see, some of the terms that we will use here, fixed cost, variable cost, etc., will be useful in the other topics as well. So ideally cost management should be the first one before I do planning, budgeting or performance management. Let's start with cost management.
Okay.
I'll share these slides with you after the class.
Okay.
Classification of costs. First of all, let's understand what is the difference between expense and costs. See, when you say expense, whatever the flow of economic resource, outflow of economic resource is going to be known as cost. That means if I pay something, that is a cost. But that will be expense only if it is eligible, if we can take that into the P&L, profit and loss account. Why it may not be eligible? Imagine I am paying next month rental now itself. You can call it a cost, but for this month that is not an expense. Why? That is for next month. Understand? So expense means anything that qualifies, that can come into the income statement, P&L. So that's the summary. Now let's see what they say. Costs are resources given up to achieve an objective. Expenses are costs that have been charged against revenue in a specific period. Charged against revenue means that comes in the P&L. Cost is an economic concept, while expense is an accounting concept. Implicit costs and explicit costs. Explicit cost means what? The most of the costs that we study are explicit costs, paying rental, paying salaries, all these expenses, explicit costs. That will be recorded in the statements, in the P&L. Administration expenses, marketing expenses, research expenses, delivery expenses, everything is explicit cost. So what is implicit cost? There are some expenses, there are some costs which doesn't come to the income statement. See, some costs that do not reach the income statement. Example, opportunity cost. Let's try to understand opportunity cost. What is an opportunity cost? Let's say we are manufacturing a product X. Because we are manufacturing product X, because of this product Y had to be given up. Maybe you had a limited capacity of production. So when you chose product X, you had to give up product Y. Okay. Now when you prepare product X's profit statement, you will take revenue, cost of sales, gross profit, other income and expenses, then profit. Now my question is, because you have given up product Y, you have some loss of contribution, loss of profit from product Y, right? Because you are giving up another product. That is what we call opportunity cost. Opportunity cost means when you are making a choice, you give up some other benefits, but some other choices. So they have some benefit. You are giving up product Y that has some profit, that has some contribution margin. Now, this opportunity cost, as per the accounts, as per the accounting standards, we will not show here as an expense. Have you ever seen in the financial statements opportunity cost being shown as an expense? Never. Never. We will have cost of sales, which is material, labor, overheads. Other income expenses means administration expenses, research expenses, selling and distribution expenses, all that will be there. Interest expense will be there, tax expense will be there, but nothing, no opportunity cost. So that is what we mean by implicit cost. There are some costs which do not reach the income statement. Implicit costs such as opportunity cost never become expense in the accounting records, but they are costs nonetheless because they represent resources given up to achieve an objective. Implicit costs are costs that do not involve any specific cash payment. This is another feature. It did not involve in a particular cash payment and are not recorded in the accounting records. An opportunity cost is a contribution to income that is lost by not using a limited resource in its best alternative use. We saw the example now. Direct versus indirect costs. Direct cost means cost that can be traced with the product. Let's take a product and let's try to understand. For a furniture manufacturer, let's say he makes a batch of tables. So what would be the direct cost for him? Obviously wood or timber. The thing is this, when you finish this batch of tables, whatever the cost that can be traceable for that batch, whatever the cost that can be directly connected to that batch is direct cost. There will be some expenses which are not specific to this batch, more like common in nature, that will be indirect. So I can say wood, we will know how much of wood we have used for this batch, we will know. Labor, we will know, because how many hours of labor had been used for this batch, we can find it. What is indirect? Think about factory rental. That's not specific for this batch. Factory manager's salary, administration expenses, all these are indirect costs. Factory rent, factory cleaning, factory manager's salary, these I can call it indirect cost. To be more specific, I can say production overhead. Wait, what is overhead? Indirect cost have another name, overheads. Indirect cost. And why I say production overhead, look at all these examples I have taken. Factory, factory, factory. All of them are from the factory itself, right? That's why production overhead. These are direct costs. So what could be non-production overhead? non-production overhead. Whatever that is not in the factory, for example, administration expenses, admin cost, selling and delivery cost, selling and distribution. See, they are also overhead because you may not find specific for a batch. These are mostly common costs, and they are not from the factory, they are outside the factory, so you call it non-production overhead. Sometimes we say manufacturing overhead, non-manufacturing overhead. So there are actually three types of cost now. If I put it like this, costs I am dividing into two: direct, indirect. Indirect is what you call overhead. That I am further dividing into two. This is manufacturing overhead, non-manufacturing overhead. Cost based on production. That means when the number of units changes, what happens to the cost? Based on that, we have three types. Variable cost means number of units. Cost, if you see total cost, it changes like this. Example, raw materials cost. You make more and more units, you need more and more raw material. Fixed cost, number of units. Like this. Factory rental. Whatever the number of units you are making, you are going to pay a same rental, fixed rental. So that is fixed cost. Mixed cost means it has both element. It has both fixed and variable element. How is that? A salesperson's salary, basic $1,000 plus incentive $10 per unit. Now look at this. This basic monthly $1,000, it's fixed. Whatever the number of units he sells, he gets his $1,000. But this incentive part, that's going to be variable. Because that's based on number of units. So there is a fixed element, there is a variable element, both together you call it mixed cost. Mixed. You can see here variable cost, costs such as material and labor that are incurred only when product is made. The per unit variable cost remains unchanged. This is one of the important features of variable cost. If you look at variable cost per unit, that means raw material per unit, how much of wood is required for one table, how much of fabric is required for one shirt. So that unit cost doesn't change, that remains constant. That remains constant with number of units. Only the total cost increases, which I have already shown. This is total cost. If you ask total material cost, that increases like this. So the per unit variable cost remains unchanged as production increases or decreases. Total variable cost increases as production increases and decreases as production decreases. That is this graph. Fixed cost do not change within the relevant range of production. That's the other thing. Within the relevant range of production. See, for example, if I'm running a training center, maybe I have taken a space where I can accommodate 20 students and I'm doing a class. So my rent is fixed. Until when? Until I get 20 students. If I get more than 20 students, this space is not enough for me. I'll have to go for a bigger space. When I go for bigger space, I'll have to pay a bigger rental. Think I'm taking another space, I'm giving up and I'm taking a space with 30. So rental increases. So fixed costs remain constant within a relevant range, not forever. Within a range, it remains constant. Read again. Fixed costs do not change within the relevant range of production. As long as the production volume remains within the relevant range, the total amount of these costs does not change with the change in the production volume. Cost per unit decreases as production. What will happen to the cost per unit? Fixed cost. We saw total fixed cost with number of units. It's constant. Fixed cost per unit versus number of units. That takes a shape like this. It falls, but not straight line. It's a curve. It's a curve. Mixed cost have both fixed and variable components. A semi-variable cost is a small fixed amount plus variable amount. A semi-fixed cost stays fixed for a given range, then jumps to the next highest level where it is fixed for a while. Look, semi-variable is another name for mixed cost. Semi-variable. Cost is a small fixed amount plus a variable amount. Okay. Semi-fixed. What is semi-fixed? Actually, the correct name would have been step-fixed. Semi-fixed is not a common term that we use. Step-fixed. What is step-fixed? This kind of cost is known as step-fixed. Can you see the fixed cost? When number of units exceed a certain point, it goes up and it goes to another level and remains constant. When number of units exceeds another level, it goes to a third level and remains constant. So step by step it increases. Can you see? Not gradual, not like this, not like that. Step by step. There is one constant level, then another constant level, then another constant level. This is called step cost. Total cost equals, going back to that example, which one? The salesperson salary. I said 1000 basic plus $10 per unit. So I should multiply by number of units. This 10 I have to multiply by number of units to find the total incentive. So this is what they here see. Total they say here. Total cost equals, what is this 1000 fixed cost? What is this 10 variable cost per unit? What is this number of units? That is X. Number of units is X. Total cost equals fixed cost plus this bracket gives you the total variable cost. How do we get the total variable cost? 1 unit's variable cost into number of units. We will finish the theory and we will go to the questions at the end.
Okay.
Product versus period costs. In addition to the classification of costs based on their behavior as production changes, costs can also be classified according to their purpose. Main distinction of costs that are based on purpose is production cost versus period cost. What is production cost? whichever increases or decreases with the production level, or it's connected to the production. Let me show you examples here. Okay. Product cost or inventoryable cost are those costs that go directly into the production process, without which the product could not be made. So if I go back to one of my previous slide, I explained this cost and this cost together, you call them manufacturing cost or production cost. What are they? Direct cost and manufacturing overheads or production overheads. Can you see here? Direct material, direct labor. So these two are direct. Then manufacturing overhead. Actual manufacturing overhead, utilities, rent. Indirect labor means factory manager's salary, factory accountant, factory cleaning staff. That is indirect labor. Indirect material means any stationery used in the factory, any cleaning materials used in the factory. Those are materials, but not direct, indirect.
Okay.
Grouping of product cost. Prime cost. Prime cost is another name for direct cost. Prime cost is another name for direct cost. So prime cost means direct material and direct labor. Manufacturing cost is these two plus manufacturing overhead. This term applied has a lengthy meaning. We will come to that later, not now. Conversion cost. There is another name, conversion cost. What is conversion cost? See, we give the raw material, the production process happens, and you get the product outside. So whatever the cost you incur in this gap is known as conversion cost. You are converting the raw material into products. So basically production cost except material. Material cost already paid. After paying the material cost, whatever the production cost. So but what comes there? Labor and manufacturing overheads. Labor and manufacturing overheads. So let me rewrite these once again. We have direct material, direct labor, manufacturing overhead applied. All of them together you call it product cost. Then these two together prime cost. But these two together conversion costs. Know the terms, conversion cost. So we were discussing about product cost. Product cost only we have all these three: material, labor and manufacturing overhead. Within manufacturing overhead, what do we get? Indirect material, indirect labor, other production expenses. Indirect material, you know, factory stationery, factory indirect factory material or indirect production related material, not from the head office, not from marketing. Manufacturing related indirect material, indirect labor, and like factory rental, electricity bill, stuff like that. Period costs as compared to product cost are costs for activities other than production of the product. So this is where we will get administration cost, marketing cost, selling and distribution, research. All this you can say period costs. Even if these costs were not incurred, the product could still be manufactured. Period costs are usually expensed as they are incurred. What's the meaning of that? These product costs. Okay, let me take an example to explain this. Oh wait, we'll take that with the questions. Okay, I'll explain this one. Just remember this point for now. Period costs are usually expensed as they are incurred. If I briefly explain now, factory rental or not factory rental, let's say head office rental, each month whatever the amount of rental, it is expense, it is shown in the P&L as the expense. But we may not do the same for factory rental. Factory rental, what we may do, we might divide that by number of units and we allocate that for each unit, we apply that for each unit, and when the units are sold only, that will come as an expense. If the units are not sold, in a month that there is no unit sold, factory rent might not come to the income statement. Repeat, these period costs they are not connected to number of units at all. Whenever they are incurred, they are going to be expensed in the P&L. They will be shown as an expense. But material, labor and production overheads, they are connected to the products. Only when those products are sold, it goes as an expense. If the products are not sold, it remains in the inventory. For financial reporting, they are expensed. For internal decision making, they may be allocated to production departments. We'll do this later in this section. We'll see that later. Other cost terms, implicit, explicit, I already explained. Opportunity cost, I already explained. Carrying cost means basically the past cost as incurred. For example, where do we use this term carrying cost? For non-current assets. Carrying cost means cost minus accumulated depreciation. Cost minus accumulated depreciation is what we call carrying amount for non-current asset. So basically, based on the past figures, based on the past cost, what is reflected is carrying cost. Sunk cost means what is already incurred. For example, material, whatever the price that we have already paid is sunk cost. Already incurred costs are known as sunk costs. These terms are not so used in the financial accounting, but in management accounting, decision making, we will use these terms. Committed cost means it's a future cost, but already you have made the commitment. For example, you entered into a contract already to pay some marketing expenses. Now, whatever happens in the future, you have to pay that amount. Committed cost. Discretionary cost, important term. Discretionary cost means cost that managers have the freedom to decide when to spend, how much to spend. Good example for this is marketing cost. Managers have to decide what marketing activity to do. You don't do the same activity always, not like production cost. Production cost, managers don't have much freedom to decide because it's a routine thing. You have to keep doing the same activity again and again. But marketing, it's different. What you did last year marketing, this year marketing could be different. Who decides it? The managers. So, if the managers have the freedom to decide what to spend, how much to spend, when to spend, then you call it discretionary cost. Very good example for that is marketing cost in an organization. Marginal cost. Marginal cost means cost incurred when one additional unit is produced. So you are already at 500 units. You want to increase to 501 unit. How much extra cost you have to incur for that 1 unit is marginal cost. Imagine in a classroom I already have 10 students. If I add the 11th student, am I incurring any additional cost? If I am incurring any additional cost, that is marginal cost. So usually marginal cost will be equal to usually variable cost of units, because fixed cost doesn't increase. Building rental won't increase. Salaries won't increase. Only variable cost. In the case of students, if I am giving books from my side, when one student comes extra, I need to print one more book. So variable cost is usually equal to the marginal cost. Last one in this slide, engineered cost. Basically material and labor together, you call it engineered cost. Definite physical relationship to the activity base or measure. That means each table one by one I can take and tell, okay, this table has costed this much material, this much labor. Each shirt I can take and say, okay, this much fabric, this much labor. That's that engineered cost. Overheads might be difficult to say like that, but this one we can say that's engineered cost, material and labor. Cost of goods sold. Wait, we'll go step by step. Direct material, direct labor, production overheads. These three together, how do we call it? Cost of, or let's say manufacturing cost. Manufacturing cost. Then this manufacturing cost plus opening work in progress minus closing work in progress. Work in progress means half completed items, part completed items. Do this adjustment, what you get is COGM, cost of goods manufactured. See, this is not cost of goods manufactured, because this might include the cost of part completed items also. So I have to adjust for the part completed items, then we get cost of goods manufactured. Cost of goods manufactured plus opening finished goods stock minus closing finished goods stock this is what you call cost of goods sold. The cost of the goods that have been sold, COGS, cost of goods sold. See, beginning finished goods inventory, purchases or cost of goods manufactured. Cost of goods manufactured. See, if it is a retailer, somebody who is buying and selling, this one, instead of COGM, he will have purchase. Because he doesn't manufacture, right? This whole thing is not going to be there for him. He just buys and sells. So for a retailer, we will say purchases plus opening stock minus closing stock. That is what this says here. Purchases for a reseller. Cost of goods manufactured for a manufacturer. This is what I already have explained all this. You can see here material. Regarding material, there is another complication. Let me tell you. This is material used. Sometimes they give purchased amount. So how do we find the used amount from the purchased amount? Material purchased plus opening raw material inventory minus closing raw material inventory, that will be the raw material used or direct material used. Let's say direct material. If purchased is given and if the inventories are given, direct material inventory is given, do these adjustments to find direct material used. That is what is here. So I have given you 4 equations here. How to find manufacturing cost, how to find cost of goods manufactured, cost of goods sold, direct material used. Direct material used in the period plus direct labor used plus manufacturing overhead applied. Total manufacturing cost. Then you adjust for work in progress beginning and ending, cost of goods manufactured. Right. With this much, let's go and do some questions. So we have done the first 3: cost, classification of costs, costing systems, cost of goods sold and cost of goods manufactured. There are 53 questions in this. I'll take all 53, but doesn't mean I'll do all 53. A firm calculates that its annual cost to hold excess goods in order to avoid any chance of running out of inventory is 50,000. This 50,000 is an example of
Stop. Cost.
no
Carrying
carrying cost. What is stock out cost? If you run out of inventory, because of that, whatever the cost that comes. Repeat, if you run out of inventory. So if you run out of inventory, you may have to return some of the customers. So there is some loss of sales. This will have reputational damage. They might not have a good opinion on your business. Next time they may not come to your shop. They might go to another shop. So future sales might be lost. Current sales is lost. Future sales is lost. Reputational damage. All of that together, stock out cost. Once again, if the company runs out of inventory for a particular item, because of that. Here what they say, to avoid such situation what you are spending, so still stock out has not happened, right? So you cannot call it as stock out cost. It's not quality cost also. Quality cost means like any quality related cost, training of staff, monitoring, inspection, nothing like that. Prime cost is direct material, direct labor. So the most relevant cost name for this is carrying cost. Why carrying cost? It's a past cost. Hold excess goods in order to avoid, which is 50,000 worth. So this 50,000 must reflect the past purchase price of the inventory. Look at the explanation. Cost of holding inventory is not a stock out cost. Stock out costs are the costs that result from lost sales when a company does not have inventory. That is stock out cost. The cost of holding inventory, whether or not the inventory is excess inventory, is a carrying cost. Let's look for numbers. I think this chapter has all theories. Okay, try this one. The marketing manager of Ames company has learned the following about a new product that is being introduced by Ames. Sales of this product that are planned for at $100,000 for the first year. Sales commission expenses is budgeted at 8% of sales, plus marketing manager's incentive budgeted at additional 0.5%. The preparation of a product brochure will require 20 hours of marketing salaried staff at an average rate of 100 per hour and 10 hours at 150 per hour. for an outside illustrator's effort. The variable marketing cost for this new product will be
8,500.
8,500. Correct. How 8,500 comes? 8% of 100,000 would have been 8,000. And then half percentage of 100,000 is 500. These two items are directly related to sales. That means if sales increases, this will increase. Variable. Whereas other items, this is preparation of product brochure, it's not variable. When you sell more and more units, are you going to prepare more and more brochure? No, this is one-time expense. So that cannot be variable. Only these two items are variable. 8% and half percentage, that means 8.5% of 100,000. 8,500 is right. Implicit cost. Implicit cost also called an imputed cost. Implicit costs are also known as economic cost. Look at these other terms. Imputed cost, economic cost, implicit cost all mean the same. But now come back here. A cost that does not entail any dollar outlay. There is no cash payment, but it is still relevant for decision making. That is implicit cost. Let me see one by one others. Cost that continues to be incurred even though there is no activity. Fixed cost. Fixed cost. The difference in total cost which results from selecting one alternative instead of another, this is known as differential cost. There is a term called differential cost. T is differential cost. Differential cost means if I choose option A, how much is my cost? If I choose option B, how much is my cost? The difference. Differential cost. Cost that cannot be avoided because it has already been incurred, sunk cost. This is sunk cost. Wagoner company produces a product that contains 9 ounces of materials in each unit of finished goods. During the production process, 4% of the materials evaporate. Wagoner pays its suppliers $2 per ounce. The cost to ship the material to the company averages 0.2 per ounce. The standard dollar amount of raw material contained in 1 unit of finished good is. See, they do some production process. When the output comes, each has 9 ounces here. Contains 9 ounces of material in each unit of finished good. During the production process, 4% of materials evaporate. That means, if you have given 100% input, 4% is evaporated. Only 96% comes with the output. So this 9 ounce is 96%. What should have been the input here? 9 ounce is 96% multiplied by 100%. How much is that? 9.375 ounces. And per ounce cost, supplier's price is $2. Transportation cost is $0.2, so $2.2. 9.375 into $2.2. How much do you get? 20.63 could be right. In this working, the common mistake you do, you will take 9 ounce and for the 4% loss, what you do, you will add 4% of this, which is absolutely wrong, because 4% of input you have to take. In this working, what you are doing, 4% of output you are taking. Right. So this working, if you have done this working, this is wrong. What is correct? 100, 4, 96. Take this 9 ounce as 96%. 9 divided by 96 multiply by 100. 9.375. If you have done this working, it would have been 9.36, which is wrong. That answer also will be there. I think 20.59 will be that answer. Check that 9.36 into 2.2.
Yeah, 20.59.
They will give that answer also, which is wrong. A lot of data. Look at the question. The advertising and promotion cost for the product selected by Hitchcock will be which one? Advertising and promotion. What do you think? Correct. Discretionary cost. You don't even have to see the numbers. Straight away you can answer. Oh, another one on discretionary cost.
Yes.
Correct.
Yeah.
That fluctuate in total in response to small changes in rate of utilization of capacity. Rate of utilization of capacity means, imagine in a classroom if 20 students can be accommodated. If I say 50% utilization, we have 10 students. 60% capacity, 12 students. So rate of utilization changes means volume changes. That's what they say indirectly. Changes in rate of utilization of capacity. This means number of units.
Utilization of capacity.
Yes.
Okay, number of units changes. So what is variable cost? If the total cost changes when number of units changes, that is variable cost. In addition, company, okay. What were Plunkett's product cost and period costs? Okay. What comes in product cost? Direct material, direct labor, manufacturing overhead. Manufacturing overhead is there in two places. Variable, fixed, take both of them. Both are manufacturing overhead. 4 items you had 56, 179, 100, 154, 267. All these are product costs. The others are period cost, selling cost, administrative cost, are period cost. Check the answers. How much do you get? 56, 179, 154 and 267. 497, 500.
D.
This one?
D.
D. Correct. Simply adding them correctly, huh? These 3 plus this one, manufacturing overhead. Which one of the following is correct regarding a relevant range?
Total fixed
cost will not change.
Total fixed cost will not change. That's what the relevant range means.
cost.
Prime cost.
Why prime cost? This is the definition of direct cost. Cost that always can be physically traced to a cost object. Cost object means product or anything. So this is the definition of direct cost. Direct cost, another name is prime cost. Prime cost is direct cost.
Okay.
Yes, there are two things that I said it will be constant when number of unit changes. One is, remember, if I revisit the graphs, for fixed cost, total fixed cost is constant. Fixed cost per unit is a curve. Variable cost, total variable cost is a straight line like this. Variable cost per unit is constant. Here the question is about constant thing that remains the same as volume of activity decreases. So either it can be total fixed cost or it can be variable cost per unit. Those are the two that remain the same. Variable cost per unit is there. estimated conversion cost per unit are? Correct. How comes 41? Conversion means labor and overhead, manufacturing overhead. So direct labor and manufacturing overhead means these three items. Direct labor is 20, manufacturing overhead means these two, 15 and 6, 21. 20 and 21, 41. Here conversion cost. Conversion cost means labor and manufacturing overhead together. Those two. Yeah, sum of labor and factory overhead. A. Let's check.
Easy.
A company operates 10 offices. In the prior year, the total cost of operating the offices was $1 million, of which 140 consists of fixed cost. Oh.
1.1750.
Let me also do it. Offices, operating office 1 million. Okay, 1 million, 140 fixed. So variable will be 860.
Yeah.
Yeah.
So this is for 10 units, right? So if I take variable cost per unit, 860 divided by 10, 86,000. Now they ask for 12. So for 12, fixed cost 140 plus 86,000 into 12. Isn't it? That's the variable cost. This is the fixed cost. You get this answer?
Yeah.
Yeah.
Okay. Let's check. Correct.
Cost of raw materials.
Yes. Management projects that it will manufacture 13,500 cases next month. What will be the total manufacturing overhead budget? First of all, identify which ones are manufacturing overheads. This 3.5 is manufacturing overhead, because indirect factory wages, indirect labor, indirect material is here, that's factory overhead. Supervisor's salary must be factory overhead, that is within the factory. All these are factory, because look at the heading, manufacturing cost. That means even this 1.25 is factory overhead. But here, supervisory salary manufacturing, plant equipment depreciation manufacturing, factory insurance manufacturing, but this is not manufacturing. Advertising is not manufacturing. Just a second. So can I say this? 3.5, 1.75, 1.25, all this will be variable. 3.5, 1.7, 1.2 into 13,500 cases plus 42,000 plus 31,000 plus 19,000. Get me the answer. Is it 179,750?
9,750.
179,750.
Shall we check the answer? Correct. Right, so you will try the rest of the questions. How many questions I have done out of 53? At least 10 did I do? 1, 2, 3, 4, 5, 6, 7, 8, 9, more than 10. Around 15 questions I have done. You have the remaining, you do it. Now let's take section B and see, like in that itself, out of what we finished now, these two costing systems, there are 8 questions. Cost of goods sold and manufactured, there are 14 questions. Let's see what is there in these two. Wait, costing systems we did not study, but cost of goods manufactured and sold we have done. So let me reselect the area. This one, the slides did not come yet, but this we have done. Information contained in cost of goods manufactured budget most directly relates to the which ones?
Cost of goods manufactured.
Go back and see the process, the format I gave you. Material used, direct labor, overhead applied, that will be manufacturing cost, and work in progress inventories budgets. Yes, correct. The cost of goods manufactured by the company for the fiscal year. Look here, sales is given, gross profit is given, so I can find cost of goods sold. 160, 148 means 112 it is going to be. Cost of goods sold, what's the formula? Cost of goods manufactured plus opening finished good inventory minus closing finished good inventory is cost of goods sold. This is 48. Opening finished good inventory 60,190. Closing inventory, year end finished goods 58,300. So you have to go backwards. So when you are going backwards, do the opposite operations. 48,000 plus 58,300 minus 60,190. What do you get? $46,110.
Yes. So just 1 second, can you just...
No, I made some mistake.
The cost of goods sold need to take, na? We took gross profit.
Yes. 112,000 is the cost of goods sold.
Yeah.
Check the answer and we'll come back. Yes.
Yes.
I made a silly mistake. You try this first and Faber company employs a normal absorption cost system. The following information is from the financial records of the company for the year. What's the requirement? Total cost of direct material used by Faber company. Total manufacturing costs were $2.5 million. Cost of goods manufactured 2425. Applied factory overheads 30% of total manufacturing cost. Factory overhead was applied to production at a rate of 80% of direct labor cost. work in progress inventory is this. I'm clueless. Let's see. Total manufacturing cost is given, right? What's the formula for total manufacturing cost? Material used plus labor plus manufacturing overhead is manufacturing cost. 2.5 million. Applied factory overhead was 30% of total manufacturing cost. So this is going to be 30% of this. 2.5 million into 30% is 750,000. Then factory overhead was applied to production at a rate of 80% of labor. So if labor is X times 80% must be the manufacturing overhead, which is given as 750,000. Repeat, factory overhead was applied to production at a rate of 80% of direct labor cost. So X is going to be 750,000 divided by 80%. What do you get for that?
937,500.
937,500. Good. Now we find the missing figure. That's the answer. So from 2.5 million, subtract these two. 812,500. Is that right?
812,500.
Yeah.
Yeah. Try this one. The schedule of cost of goods manufactured of Rubber Fittings Incorporation shows the following balances for its fiscal year end. Direct manufacturing labor $280,000, manufacturing overhead $375,000, ending work in progress inventory 230, raw materials used in production 450, cost of goods manufactured 1,125,000. The value of work in progress at the beginning. Okay. So where do we get this work in progress inventory included? In the cost of goods manufactured. What we do, cost of we start with manufacturing cost plus opening work in progress minus closing work in progress, that is cost of goods manufactured. Cost of goods manufactured is given 1125 thousands. Ending work in progress is given 230. This is what they ask us to find. Manufacturing cost, I need to find out. Can find it. Material used given 450. Labor 280. Manufacturing overhead 375. If I add these three, that must be the manufacturing cost. How much is that? 5,655.
1.105. 1 million.
Okay. Now I need to find this figure.
Okay.
How much are you getting? Maybe I can add these two first. This is minus, so that's going to be 875 plus x 1125. Now subtract this 875 on the other side, 250.
Yeah.
MacTech company's prime cost for November is? Prime cost is what they are asking for November. So prime cost means materials used plus direct labor. That's all. But material used is not given. Material purchased is given. Here you can see material stock is given. So purchased and adjust for the stock, you can get it. Purchase also, there is another complication. Look here. Materials purchased and then transport cost is there. Purchase returns are there. We need to adjust for all these three. 163 at the transportation cost, 167, then subtract the returns. So 165 is going to be the actual material purchase cost. Then with that amount, adjust for the inventories. You'll get material used. Then at the labor. You try first. Correct. Correct. How?
Yes, I got it.
You got it. 163.
Yeah.
4 minus 2, 165. Then 165 plus opening minus closing, 170 is the used amount. With that, you add this 200. 370. Another one. Peterson's Planters Incorporation budgeted the following amounts for the coming year. Beginning inventory. You got the answer?
315,000. I don't think so.
1 second.
Direct labor. Okay. Or from cost of goods sold, we have to find the cost of goods manufactured.
That's good, yeah.
From that, we had to go back to manufacturing cost. Step by step, 3-step working it's going to be. Okay, now let's see. What they want is labor. So you know, material used, labor, manufacturing overhead is manufacturing cost. From manufacturing cost, opening work in process, closing work in process is cost of goods manufactured. From cost of goods manufactured, opening finished good, closing finished good is cost of sales. Cost of sales is even cost of goods sold. Cost of goods sold. That is given 400,000. What else is given? Ending inventory of finished good 25,000. This is 25,000. Beginning inventory of finished goods 10,000. Right. From this we can find cost of goods manufactured. This is minus 15 means this should have been 415. Am I right? If cost of goods manufactured is 415, there is a work in progress inventory opening and closing 0. So manufacturing cost is also 450. Now in this 415, material used in production 100. Where is the manufacturing overhead? Overhead is estimated to be 2 times the amount of direct labor dollars. So if this is X, this is 2X. 2 times. Isn't it? Overhead is estimated to be 2 times of labor. So 2X. Now 100 plus X plus 2X means 3X. 450. 350. 105. That is what they ask. How much is labor? Labor is 105. I think that's enough for today. We have done quite some work. Revise all this. for tomorrow. Let's have a look at the slides now. Where are we? Costing systems. Now only it comes. Okay, I have to study costing systems. Then method of allocating overhead, volume based, activity based. Okay, which we can finish. After that, second set of slide, join product by product. Okay, I think tomorrow we can try to finish costing systems and then join product by product as well.